Welcome to this first video in a series looking at technical indicators. If you want to learn more about technical indicators, this is a great place to start. So in this video, we're going to look at what technical indicators are in a general sense. We're then going to look at a group of technical indicators known as oscillators, and then we're going to finish by concentrating on one specific oscillator, that is the rate of change oscillator, or ROC. So we'll explain what that is and how that works. So do keep watching to the end of the video so that you get to hear all about that. Hello, I'm Peter Martin with Trading 212, and we add educational videos about trading, about the financial markets, about investing to YouTube regularly. If you haven't already, make sure you subscribe to our YouTube channel just by clicking on the red subscribe button, because that's the easiest way to find out whenever we've added a new video. Well, let's not waste any time. Let's jump in now to take a look at what are technical indicators. Technical indicators are tools that are designed to try and help us with our technical analysis. So here is a representation of a price chart, and we'd have the standard axes of price along the y-axis and time along the x-axis, and the market price might have been doing something like this. Now, one way of analyzing this would be purely by looking at it and trying to recognize what is happening, maybe identifying visually where there is evidence of, let's say, support or resistance, or maybe spotting a breakout, or recognizing a reversal pattern that has formed, and so on. So we are observing price data and trying to judge what is happening in the market from what we observe. And price charts, therefore, help us to see these market movements, to see what is going on. But we can also get a helping hand to try and identify what is happening with the help of technical indicators. So now, rather than just solely looking at the price chart, we can instead plug the price information into our technical tool, and the tool will perform a specific function with that price data. Maybe averaging numbers over a period of time in a certain way, maybe comparing the current price to some other price measure, perhaps a price at some point in the past, and it will deliver some kind of output for us to consider. And the specific function of the tool will be designed with a certain use in mind. So we might need to use different tools at certain times. Tool 1 here might be designed to help us time buys and sells when a market is range bound, like this part of the chart, whereas tool 2 might be designed to help us identify, let's say, if a breakout has occurred. So a technical tool, once you turn it on for a market, is basically always churning out output. You apply it to a market, it does its calculation, gives its outputs, and occasionally those outputs might be trading signals. And one crucial thing to be aware of, though, is that we can't just blindly follow these signals and expect them to be correct. Ultimately, it's up to you, the trader, to put on your thinking cap and then to consider those signals and evaluate if you want to act on it or not. And part of that, of course, will entail understanding what the indicator does, how it works, and what the signal is actually saying. And these are some of the things that we're going to consider in these videos. Now, the first group of tools that I want to look at is a group that is called oscillators. These are used to identify what are usually described as overbought or oversold markets. These indicators are constructed so that their value tends, as the name suggests, to oscillate. That is, to perpetually move up and down, to swing back and forth like a pendulum or a yo-yo around some kind of neutral point. For example, an oscillator might be designed to swing between 0 and 100, like with this one here. Or another might be designed to have 0 as its mid price and to swing either side of that, as with this one here. Now, the outer bounds to which the oscillator can swing are intended to represent extreme highs or extreme lows. And then you might have some region marked on your oscillator that denotes either overbought or oversold. So here we are in Trading 212's web app, and I'm looking at a daily chart of Coca-Cola. That doesn't really matter, that could be anything really. And I'm going to right click, and we can see that one of the options available is indicators. So if we follow that through, then we can see that we have a number of types of indicator, and it's oscillators that we're focusing on in today's video. And then we can see that we have a long list of oscillators that are available. Let's choose one. Let's choose the rate of change oscillator and add that to our chart. So we get a choice of how many periods to look back over. We're going to leave that this default value of 12. We can choose a color that we want for the oscillator's line color, and we can choose a thickness. Let's just all leave these values at default because this is just to demonstrate what it looks like. I'll click confirm, and there the oscillator appears at the bottom of the screen. So it's separate to our price chart, and we can see that the oscillator goes up and it goes down and it comes back again. So what was happening with that oscillator, and what does it mean? Well, let's now focus specifically on the rate of change oscillator and try and answer those questions. The oscillator we added to our chart was the rate of change, or ROC oscillator. And this is what is known as a momentum oscillator. It is looking at how much price is accelerating or decelerating. So it's measuring how fast price is changing and in which direction. Another way of looking at this is it's like a measure of how much va-va-voom is behind a move. Are things just edging up or down, or is there a lot of vitality, a lot of weight behind the move? Now it does this by looking at the current price and then comparing it to the price n periods ago. So when we just added that oscillator, we put in 12, the default value. That was the number of periods ago that we're making this comparison. And it's one of those indicators that oscillates around 0. So what is actually happening with the ROC when it is making that comparison, that look back to n periods ago? The price goes in, and the formula is the current price, P, minus the price n periods ago, divided by that price n periods ago, and then that whole thing multiplied by 100, and then that is the value of the ROC oscillator. So if we now go back into the app, and this is the chart of Coca-Cola again, I've got this on a candlestick chart now. That's just because it makes it much easier to see the different periods. If we look at this current candle, then the close is 51.89, so that's our current price. And then we go back 12 periods, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then the close there is 54.7. So those are the numbers we'd work with. And if we plug those into the formula, then we get 51.89, the current price, minus the price 12 periods ago, which was 54.7, divided by that same price, 54.7, multiplied all through by 100, and the output, the ROC output, would be 5.14. And if we go back to the web app again and go to the oscillator at the bottom of the screen, we can see that 5.14 is the current value of the ROC. And really what the indicator shows us isn't all that complicated. When the current price is greater than the look-back price n periods ago, then we're going to get positive values of the ROC. When the current price is less than that look-back price, we're going to get negative values for the ROC. And when the current price is equal to the look-back price, then we're going to have a value of 0 for this oscillator. So this phase here, say, is showing a negative value for the ROC, so that the market price at that time was weaker than it had been n periods ago. And then this switch up through the 0 point and into positive is showing a shift in the momentum, moving into an upward phase. And here we have a basic signal for this indicator, which is a swing across the 0 line. A swing from positive into negative is generally considered a bearish signal, and from negative to positive is generally considered a bullish signal. Now, we already saw that the default value for N in the app is 12, so that's 12 periods, and you can evaluate how this works for you by using practice mode in the app. But generally speaking, if you lean towards shorter term trading, it might be an idea to tweak that number a little bit lower. And if you are a longer term trader, it might be an idea to have that number greater than 12. Ultimately, use what you find gives the best results for you. Well, I hope you enjoyed this introduction to technical indicators and this look at the ROC oscillator. If you did, please just take a moment to hit the thumbs up button and give us a like. Or why not share your thoughts with us? Do you use oscillators? What do you think of the ROC oscillator? By sending us a message in the comments section. We do read each one we receive there. Well, do join us next time when we'll be exploring oscillators in further detail. But for now, that's all from me, Peter Martin, and Trading 212. Thanks for watching. Goodbye.